Accommodative Fed policies lead to inflation concerns. Life is too short to worry about what the next headline could do to your life savings. Hi, my name is Eric Hagan, and I keep my thumb on the pulse of the economy and the markets so my clients can focus on the things that are actually important to them. Thank you for joining me the next few minutes on today's weekly economic video update. Rising bond yields dampened investor enthusiasm for high multiple growth companies last week, sending market averages mostly lower in a holiday-shortened week of trading. The Dow Jones Industrials average gained 0.11% for the week, but the Standard & Poor's 500 fell 0.71%, and the NASDAQ Composite Index slid 1.57%. The MSCI EAFE Index, which tracks developed overseas stock markets, declined 0.26%. The 10-year Treasury note yield hit its highest level in a year last week on worries of a pickup in inflation, while the 30-year Treasury bond yield ticked over 2%. Rising yields weighed on the high valuation growth stocks, most specifically the big tech names, in addition to dragging down interest rate sensitive sectors like utilities and real estate investment trusts. Economic data painted a mixed picture of the economy. Jobless claims reflected a still struggling labor market, while a strong retail sales number and an above consensus PPI, which stands for Producer Price Index, reflected strong consumer spending and building inflationary pressures. Stocks were flat as the week came to a close as traders wrestled with the cross currents of positive economic data and a further rise in yields. After a long period of low inflation, concerns are growing that higher consumer prices may return as a result of an accommodative Federal Reserve monetary policy and fiscal spending in response to the pandemic. Tensions heightened last week with the release of January's PPI report, which saw a jump of 1.7%, the biggest monthly increase since 2009. While the Fed believes that any price increases will be fleeting, the market appears to view inflation a bit differently. The prospect of further stimulus and more reopenings are adding to investor unease, which may revive an old Wall Street practice: inflation watching. Hey, this is Eric again. That's it for today. Don't forget to subscribe before you leave. To learn how I give my clients' life savings the attention it deserves, visit me online at www.erichagan.pro. If you'd like to get financially organized, go check out nocostfinancialdashboard.com. And lastly, if you'd like to take control of your 401k at work, visit us over at 401kinvestmentpros.com. Thank you again for your time today. I'll look for you next week.